From Ticker Studios, this is the Property Playbook, presented by Hotspotting.
With interest rate rises and a punitive federal budget, you might believe the best opportunities for property investment are gone. Well, think again. I'm Terry Ryder and the Property Playbook starts now. In the 20 years since I started the Hotspotting business, there have been several periods of major disruption, including the global financial crisis and more recently the COVID pandemic, which prompted media at the time to forecast a collapse of property values. It didn't happen. We're now in another disruption phase with rising mortgage rates and an unfriendly federal government. But out of these periods of uncertainty arise opportunities for investors who stay focused on the fundamentals. Now, joining me today to discuss these issues is one of Australia's busiest buyers agents, Jasvinder Gill. Jas, welcome.
Thank you, Terry, for having me.
Tell me a little bit about your business. I've known you for quite a long time. I think I know how you operate, and I really do like the way that you go about your business as a buyer's agent. Just tell me a little bit about that.
Right. So at Bullseye Capital, we believe in building sustainable, diversified property portfolios, irrespective of what the family income is. So what we try to do is, based on the client's individual circumstances, build them a portfolio of multiple properties of 4 to 5 so that they don't have all their eggs in one basket. We have bought around 200 plus purchases, and what we are seeing is that the educated investors are coming again and buying again with us. So one thing that we do, something unique at our end, is I visit a place before we start buying out there. I call this as a field report after we have shortlisted it through our research. And that field report or that field visit, where I stay there for 4 to 5 days, inspect properties, understand the local market over there, that is the final tick mark before we start.
And that's one of the things I really like about the way you go about your business. You won't recommend an area and buy an area for your customers without first visiting and spending some serious time there.
True. Yeah. And it helps me understand more about that local market, things that are not understood from the data points.
Yeah.
Understand what within that market is the growth driver, where is the organic growth coming from, what are the existing local homeowners looking for, and why they are migrating over there. Apart from the fact building our relations with the real estate agents out there. But this on the ground, feet on the ground report is my final tick mark.
Yeah. Okay, so we're in times of uncertainty, obviously, right now. We've had announcements on the federal budget on May 12, but nothing's finalised, nothing's legislated. So it's creating a period of uncertainty. We've seen some weakness in markets as a result of that, including auction clearance rates in the big cities. My feeling is that media has overreacted to that. What do you think about the sort of reaction we're seeing to this period of uncertainty?
See, yes, the auction rates in Sydney and Melbourne have fallen below that general time percentage of 60%, and that is causing some amount of correction in those markets to some extent. However, if we go back in history and see whenever this has happened, the regionals actually have performed much better. And today also we are seeing that in regionals, the market growth is still continuing. The Totality House Value Index report that has just been released recently also shows that regionals are performing much better even in May or even in the last quarter as compared to capital cities. So overall, yes, there may be some slight correction in certain capital cities to some extent till the time there's some uncertainty. Once buyers see after that 2-month or 1-month timeline that it is still picking up, they will get back into the market even in those capital cities.
I was interested in the price data that came from Totality and PropTrack and others as at the 1st of June, because at that point we already had the federal budget and we'd also had 3 interest rate rises, so lots of disruption already. But I was pleasantly surprised at how strong the price data was out of maybe 15 market jurisdictions across Australia, 8 capital cities and the state territory regional markets. Most of them actually had price rises in the month of May, which but the media kind of reacted like prices were falling everywhere. So there's been a bit of a disparity between the reality and what the media is saying about as consequences of the budget.
Right. See, the media always thrives on negative news, and this is not only about Australian media, this is about media everywhere. Yeah. That negative news is what catches somebody's attention. Sure. Right? So when that comes in, yes, the same thing had happened during COVID also. when probably a massive market crash was expected as per certain media reports or certain other professionals in the industry. But none of that happened, right? So whatever is happening today is a very small thing as compared to when we were facing the COVID uncertainty period. So today's uncertainty is very trivial in front of that.
Yeah, it's relatively minor. I mentioned in the intro the global financial crisis when certain pundits were predicting 40% collapse in Australian property prices, which of course didn't happen. And then COVID, we had similar forecasts. One of the Commonwealth Bank forecasts, I remember back in time of COVID, said prices were going to fall 33%. And actually what we got was an incredible property boom. So what do they know? So again, media is overreacting. What about investor clients? What's the reaction that you're getting? Is there a sort of hesitancy? Are people hitting the pause button, or are they just getting on with business?
No, what we are experiencing at our end is that all the seasoned investors, all the educated investors are in fact coming back and buying again. So just last night I was with a family who have just settled their 4th investment property with us a month ago. And they were last night discussing the next purchase, which should be started immediately. So the seasoned investors adapt to the changes or the circumstances, and the naive investors try to hit a pause. So I will say that investors adapt to the strategies or the circumstances. They change either their budget, or they change their location, or they change the rental yield that they're targeting, but they know that fortune favors the brave.
Okay, so what's your advice to those people who are a little bit nervous in this uncertainty? What are you saying to people?
So generally, if there's trying to run at somebody who's trying to buy at a 700K budget now with the negative gearing possibility of changes, we are trying to take them to a 500, 550K budget so that the rental yield is relatively better, change the location as per that so that they can hold on to it for 8 to 10 year period of timeline and basically understand the cash flow in more detail, so that they don't end up with a property which is with a very low rental yield and are ending up with a property that they can sustain on to 8 to 10 years.
Yes. So if you've got a positive cash flow property, the whole issue of negative gearing becomes irrelevant, doesn't it?
Well, to some extent, yes. But then, of course, positive cash flows also, properties or locations come with their own disadvantages too.
That's
so
right.
that is more important to look at that whole package of cash flow plus capital growth, because the final intention of property investment is capital growth.
Sure, but I think you and I both know from experience, long experience in the market, that if you get your locational choice right, you can have both, can't you? You can have a good rental return and you can have great capital growth. And we'll talk about some of the locations where that's been, but you do agree with that proposition?
Yes, so that is why I'm a big fan of regionals. So regionals did not start booming only after the COVID boom came in and people wanted to move out of capital cities and move to better value proposition areas like regionals. It started with probably around 2018 or 2019 that regionals started growing better than capital cities. And regionals give that dual advantage of a better rental yield of around 5% or more and a very good capital growth also, irrespective of market conditions.
You know, I call it the winning trifecta of real estate. You get a lower buy-in price, you get excellent capital growth, you choose your location well, and you get the superior rental yields, a win-win-win situation. So you've got this focus on regional markets and a price range that kind of dictates that people do look regional. Some people think it's risky. What do you say to that?
Well, if we look at what the initiatives the government is taking in building, in infrastructure projects, job creation in regional, it will be very surprising that those projects which may be quantum-wise a smaller billion-dollar value than a capital city project, that impact of that project on that smaller regional town is far, far greater than the $6 billion project being done in a capital city. Two, COVID taught us that it is more important to have a better quality life. So rather than buying a $500,000 townhouse or unit in a capital city with a negligible backyard, people are going in that same budget to regional where they have a big backyard. The value proposition of what they're buying out there is much better. And this was expected to last only for 1 or 2 years after COVID. So by 2022, that regional push or that internal migration should have stopped, but it has not, because people have learned that the quality of life is better in regional, and that's why it is continuing.
But it was never about COVID. You observed earlier in our discussion that this trend of people moving to the regions didn't start with COVID. It's actually been going on for longer than that. It was actually about affordable lifestyle,
Yes.
and at Hotspotting we call it the exodus to affordable lifestyle. It's been going on out of Melbourne and Sydney for more than 10 years, by our observation, and it's about I think technology has allowed people to work remotely, for example, as one of the motivators of that move. So the booster prizes in some of these regional towns and cities has been about not just about investors looking for affordability and better, but it's also people moving there as home buyers. So you've got that double boost. Yeah.
Yeah, so I completely understand that there is a double boost, and this has not been only because of COVID. It has started, the regional growth has started well before that, but it did not stop, and it is probably even going more. And even earlier we used to think that, you know, regional towns with a large population size are the good centers to invest in. But what we have realized over time is even regional centers or regional towns with a smaller population size are performing very, very well. Yeah. For instance, if we take Murray Bridge, so the population is well below the general guideline of, you know, 40 to 50,000 people. But the last 3-year growth in Murray Bridge has been phenomenal. I mean, it's done much better than the average, and it's running around 70 to 80% growth in the last 3 years itself.
Yeah, I know what you say is true. I've been observing what's happened with property prices since COVID, and I think Cotality actually put out a report last year saying where have property prices moved the most since COVID struck in 2020. And their top 10 lists for Australia were all small to medium-sized regional cities, and Murray Bridge was #1 in Australia. So it's a great case study to talk to use to talk about the sorts of factors that you are sort of recommending to clients. These are the sort of places you want to buy. Smallish, but with a strong, diverse economy. There's infrastructure spend happening. They have an element of lifestyle usually about them. Do you find that? Murray Bridge is on, as the name suggests, on the Murray River, so it's got that lifestyle factor as well.
Yes, true. And yes, it is not only the infrastructure projects, but the better quality of life that regional towns do offer. And even for my own retirement, I'm thinking of moving to a regional town itself. Okay. Whenever it comes.
Have you picked out the town yet?
No, I'm still 15 to 20 years away from that, so I will look at it that time.
Yeah. Are there risks to buying in these sorts of places that might not apply to buying in a larger city, or do you think it's all upside if you get the location right?
So initially I had this thought process that, you know, you should have so much population at least before you go and buy in that area. But after observing those areas with lesser population, I have seen that they are still performing, and one of the reasons why they are still performing is because they are still affordable. And the migration into Australia, and interstate migration or within the state migration, is one of the biggest drivers of price growth over there, and also people moving to that location. So I don't see it as risky. What I will say is that most people are trying to buy properties with better cash flow, or properties at a smaller budget than what was the earlier budget that they had, and also properties that they can hold on to for a long period of time. And that is why smaller towns are actually performing probably better than most of the bigger regional towns.
Yeah. So it's a good segue into one of the questions I really wanted to touch on with you, and that is a good strategy post-budget for building a property portfolio.
True. Even today, I strongly believe that irrespective of whether these proposed budget changes get implemented or not, and if it passes through the parliament or not, it is still possible to build a strong, diversified, sustainable property portfolio, even if somebody is starting now, if they concentrate on rental yield, budget they are buying at, entities that they are buying at, and modify their strategy as compared to whatever is the latest budget proposals. And even now, I am a strong believer that property investment is one of the best investment tools in Australia, period.
Beautiful point to end the discussion on, Jazz. Thanks for coming in today.
Thank you. Thank you for having me.
You're watching the Property Playbook, presented by Hotspotting. For more, visit hotspotting.com.au.